In this module, we will examine the sources of and uses for capital for growth. If you require funding for growth, there are several places that you can get it, and each is best suited for a particular situation. Sources include using your own profits or retained earnings, essentially funding from the corporate savings, or alternatively, you can use your own personal savings. You can also choose to sell equity, also called selling stock, or you can take a loan from a bank or another party. I'll examine each of these alternatives in greater detail. But first, we should consider what the funds are for. Each use has a different implied risk, and different risk profiles will imply a different preference for the type of funding that we choose. Are we building or acquiring new assets like a building or equipment for manufacturing or even inventory? Or are we investing in marketing growth? Or possibly we need the cash to fund the development of a new product. If our need is for asset growth, for example, the development of our own manufacturing line or a new building to replace our rental, then in general these can be seen as lower risk types of investments and can be well suited to taking a loan. As well, the new asset can often be used as collateral against the loan. But one must carefully analyze their profitability to understand whether the interest payments are justified by the efficiencies gained. Alternatively, if your need is to invest in marketing, then the risk is relatively high that the return will in fact occur. For this reason, it may be preferable to sell stock or equity and not assume more debt. My preference is to use one's own retained earnings to invest in marketing, and thus often modulate or slow the growth to what you can afford. If the marketing fails, the worst that happens is that your corporate savings diminish, but you still retain ownership of your company. Marketing programs can be tested and gradually grown to reduce their risk overall. As the third case, if the additional capital is needed for product development, then this is the riskiest use of capital, since the product may not work or may not be saleable at a profit. In this case, there are several choices. First, use retained earnings and slow the development down to what you can afford. Second, sell stock with the caveat that if your development is unsuccessful, you run the reality and risk of diluting the value of your ownership and even your position as CEO. Third, and my favorite, is to use a form of debt, but not from a bank, rather from your customer. I'll describe this in detail in another module. There are two reasons for this. First, your customer knows more about his needs and your product than you do. So having them put capital at risk makes them serious about the analysis of the value of your intended product. Second, this can be done without any loss of ownership in your business. My experience is that it always takes longer and costs more than you originally thought, and having a rich partner on the hook along with you can be critical. Let's examine the advantages and disadvantages of each alternative source of capital. The advantages of using your own retained earnings are mainly that you reduce the risk to your survival and loss of control of the company. The disadvantages are that your growth will be slowed to what you can afford. There are cases where rapid growth is essential in order to secure a market position. But more likely than not, fear of being beaten in the market is not justified, and patience would be more prudent. Most founders use their own personal savings to fund their company. They have little choice, since it's difficult to secure funding when your company is only a dream. The obvious advantage of using your own savings is that you retain ownership. But the disadvantage is real, and it is that you potentially put your family at risk. My preference has been to use other people's money to start my own businesses, in combination with retained earnings in the early days. I typically began each of my businesses as a consultant, earning enough to save and pay bills. Then my consulting engagements would often lead to product opportunities for which I would seek customer financing. Getting a loan from a bank isn't as easy as one might think. Banks want collateral to protect their interests. And some types of collateral, for example, the value of the intellectual property, is of little interest to them because they don't understand the marketability of the asset. They like hard assets, like your house and your car. And if you are forced to sign a personal guarantee, pledging your personal assets, then it's really no different than the prior case of using your own savings. You're putting your family at risk. Banks will require that you make regular payments, and they will monitor critical ratios on your balance sheet. If you fall outside of those requirements, they will have the right to call the loan. Often they will require that your customers send payments directly to them that can be used to first pay off the balance of the loan. The devil is in the details of the loan agreement, and it's negotiable. Make sure that you read it, understand it, and negotiate it. When buying hard assets, the asset that is being purchased, for example a building or manufacturing equipment, can often be used as the collateral for the loan. In some cases this is called an equipment lease, and the lender is not a bank but is a leasing lender. The method that everyone thinks about for raising capital is selling stock or equity in their company. There are many advantages. Starting off, each customer of your stock becomes a partner, and each is motivated to help you and themselves in whatever way they can. Unlike a loan, you don't have to pay them back, although the purchase of your stock is predicated on a belief that somehow they are going to get a return on their investment. This implies that they want you to either go public or sell the company to an acquirer. In some cases, they can be happy with a dividend return that your company can generate annually. But this is a rare case and is fraught with other potential problems. First, dividends are double taxed, once at the corporate level and then again at the personal level. Second, the management, essentially you, have the ability to cook the books and change compensation policies in a way that reduce profitability and dividends so that your investors are in a weak position to protect their interests. The key to understand is that once you sell stock, your investors won't really be happy until the story finds some ending and the company is sold or goes public. That's their goal, and since they are your new partners, your responsibility is to help them achieve their goal. It's true that selling equity dilutes your ownership, but this is overrated as a problem. It's far better to own 50% of a billion-dollar business than 100% of a loser. Nonetheless, there is no guarantee that raising funds will enable you to grow, and that's where the real risk lies. If all you do is spend the capital and do not achieve growth, then yes, you have diluted and reduced your ownership value, but you're also a lousy manager, and often you will suffer the consequences. In the next module, we will investigate the details of selling stock.